Wake up! Get up from under your rock! The stock market's crushing it today. Which REIT stocks are benefiting? Find out next. Brandy has a ton of news. The election is behind us. Wait, save that headline for next week, week after. I don't know. We have multifamily finance, an interview with Conrad Madsen, industrial broker from Dallas, who founded a really impressive brokerage firm. You're going to like it. I love this intro. Crank it up. I have a new one in the works. Won't debut till next year. So POWER30 starts now. Simon Property Group stock is up massively today. Well, the whole market's booming on news that Pfizer's corona vaccine tests are performing stronger than expected. You heard it here first, people. Go back and watch the tape. Nostradamus has been telling you for weeks the vaccine trials are going well. I can also tell you there are companies closing in on Pfizer and Moderna with even better vaccines. The market is obviously thinking people will be flocking back to shopping malls after getting their shot in the arm. You get a shot in the arm, retail gets a shot in the arm. Hey, go Simon Property Group, up almost 30% today.
Hey there, here's a look at this week's big headlines. In a nod to the attractiveness of workforce housing, a non-traded Starwood REIT buys $645 million of affordable housing. The trust, which is managed by Starwood REIT Advisors, has acquired two portfolios totaling more than 4,600 units in the Mid-Atlantic and Sunbelt regions. The company now has more than 34,000 affordable housing units owned or under contract, making it one of the nation's top 3 owners of that asset class. That unit count is nearly 2/3 larger than Starwood's platform in August of 2019 after an affiliate purchased a portfolio of 21 stabilized affordable housing communities spanning nearly 4,500 units, mainly in Dallas, Fort Worth, Houston, and Florida. Following that acquisition, the company and its affiliates owned nearly 20,700 units in total. Whew. All right, CBRE is out with its third quarter global investment report that came out last week. It indicates the U.S. investment volume increased by 30% quarter over quarter to $64 billion, back to the level of 10 years ago, but still way down from 2019. Activity increased across all property sectors in the third quarter, led by a strong quarter over quarter rebound in multifamily investment. With a relatively stable outlook for demand and income, multifamily has been the most popular asset type in the Americas since 2017. On a year-to-date basis, industrial and logistics has the smallest decrease in investment volume at 25%. Pricing of multifamily and industrial assets has recovered quickly as they're sought after for downturn protection. Investment yield has also remained stable there. Now, office real estate, on the other hand, had the smallest, we're talking 9% quarter over quarter rebound due to continued uncertainty about long-term office usage in urban markets such as New York and San Francisco. Take a look at this chart of investors' sector preferences for the second and third quarter of this year. Hotel and retail shouldn't surprise you. But what is the deal with office leading the way? Not in the Americas, by the way, but globally. Just goes to show COVID is always surprising us. Well, it is definitely time to rethink office real estate. Everybody's doing it. According to NAIOP's most recent development report, returning to the office is gonna be challenging for many businesses in the aftermath of the COVID-19 pandemic, which forced many to close for months starting back in February or March. Safety, health, and wellness in buildings and workplaces may become as important over the next 10 years as LEED certification has been over the past decade. Cool transit-rich urban office projects of the future and their suburban counterparts, they're going to offer tenant-attracting amenities and design, but what may actually close the deal will be the safety, health, and wellness features of the building. That's according to recent NAIOP interviews with office developer owners who are on the front lines of making their projects safe places to work. According to Michael McNerney, Executive Vice President with Lowe Enterprises Real Estate Group in San Diego, quote, The current phase is a reactive phase to get people to feel better and safer about coming into the office. He goes on, the second phase is about cost-effective retrofits that can be done to existing buildings to make them safer. The third phase, McNerney says, is looking at the things that can be done to give people a greater comfort level and greater flexibility going forward. In unfortunate news, CBL and Pennsylvania REIT are the latest casualties of the pandemic economy. Both announced plans to enter bankruptcy. The purpose is to recapitalize and restructure debt. According to Globe Street, CBL and Associates Properties bankruptcy isn't a total surprise. In recent months, the firm warned stockholders it would file for bankruptcy if it couldn't secure debt relief with its lenders. During the pandemic, stock fell 22% below its pre-market price. It currently owes $4.5 billion to creditors. In addition, several of CBL's tenants have filed for bankruptcy this year. That includes JCPenney and Taylor's parent company. Now, Pennsylvania Real Estate Investment Trust filed bankruptcy as part of a plan to enhance financial flexibility, it says. That's according to a statement from the company. In October, the REIT entered into a restructuring support agreement with its lenders, which included $150 million to recapitalize the business and extend the company's debt maturity schedule. Fortune magazine called the news of a, quote, shopping mall apocalypse, stating that mall owners have been slammed by a 1-2 punch as some tenants, the Gap, have stopped paying rent or are negotiating large reductions, while other huge tenants like JCPenney and Macy's, they have just left for good. Stay tuned this month as we are hosting a call with industry leaders, including the Mall of America, about how they plan to rebuild retail. U.S. household spending rose 1.4% in September as pandemic-related aid helped boost personal incomes by 0.9% or $170 billion, according to estimates released on October 30th by the Bureau of Economic Analysis. The value of retail sales is firmly above its pre-pandemic level as Americans shifted their spending away from services, such as meals out and travel. Instead, they flocked to auto dealerships, home improvement centers, and online retailers. The constant deliveries of Amazon boxes on my doorstep is evidence of that. The economy added 638,000 jobs in October compared to the 530,000 economists expected. The resulting unemployment rate fell to 6.9% from 7.9%, according to data released by the Bureau of Labor Statistics. Now, unfortunately, another 751,000 Americans claimed first-time jobless benefits last week on a seasonally adjusted basis. That's down slightly from the prior week. But we're not seeing the type of recovery we need to get commercial real estate fully back on track. Could be because seasonal retail hiring is not giving us the boost we were expecting. Typically, retail companies start hiring for the holiday season in October and really increase hiring in November. Here's a graph that shows the historical net retail jobs added for October, November, and December by year. This is going to be something we need to monitor this year. American Tower REIT announced it will purchase Insight Wireless Group, which owns around 1,400 cell towers in the U.S. for a hefty $3.5 billion. The analysts at New Street Research pointed out that the transaction is worth about 31 times Insight's EBITDA. They wrote in a note to investors on Thursday, quote, "The multiple paid came back with a high sticker shock. It would be easy to make the case that American Tower overpaid. However, it is important to recognize that infrastructure multiples have inflated significantly over the past 2 years, and costs of capital are at or near all-time lows." Cell tower companies like American Tower are expected to continue to reap revenues from companies like T-Mobile and Verizon as 5G hits the mainstream and mobile users increasingly conduct their digital lives over their smartphones and other wireless devices. That would be me. And though the overall outlook for U.S. tower companies like American Tower continues to shift, many expect the space to remain a growth area for investors in the years to come. American Tower isn't the only company on the hunt for tower purchases either. For example, Phoenix Tower recently purchased 197 cell towers from Tower Ventures, and Melody Investment Advisors recently closed on the purchase of about 1,100 cell towers from CTI Towers shortly after acquiring roughly 500 towers from Unity Towers. That deal was for about $220 million. Get ready, Airbnb is set to make its IPO filing public next week, despite the national COVID-19 surge, according to Reuters. That puts it on course for a New York stock market debut in December. The U.S. home rental company's planned debut on the NASDAQ is set to be one of the largest stock market listings of 2020, amid a pandemic that has seen demand for house rentals surge as vacationers snub hotels to practice social distancing. Kind of makes sense. Senior housing occupancy drops as inventory increases, according to Commercial Property Executive. It says assisted living senior housing properties in the NICMAP primary markets continue to see steeper occupancy declines since the pandemic began than independent living properties, dropping 6.1 percentage points since March to an all occupancy rate of 79.1%, according to the NIC intra-quarterly snapshot for September. It was another record low for assisted living occupancy rates, although a smaller drop from the previous record low in August of 79.5%. There you go. Single tenant REITs Griffin Capital Essential Asset REIT and Cole Office and Industrial REIT agreed to merge, creating a $5.8 billion portfolio. The merger would combine similar portfolios of single tenant office and industrial properties that add up to a whopping 31 million square feet. If you're looking for capital right now, you know the market is tight, but not all lenders are being stingy. Exhibit A, Flagship Capital Partners in Houston, it has funds available through two different programs. So first, its Senior Bridge Debt Program, which provides bridge loans to acquire value-add properties throughout Texas, the Southeast, and Southwest. Flagship also offers an Equity Opportunity Fund. That's a facility by which the company partners with owners and operators as an equity investor with a particular focus on multifamily, kind of a joint venture deal. Foster Financial is making a big play in downtown Detroit with the purchase of 211 Tower and plans to modernize the office space. While Dan Gilbert, the founder of Quicken Loans, has long been the dominant investor leading the resurgence of downtown Detroit, it doesn't mean that others aren't investing in Michigan's largest city. Take Brad Foster. This 28-year-old founder and president of Grosse Pointe, Michigan-based Foster Financial is quickly becoming an important investor in the Detroit area. Foster partnered with Grosse Pointe-based Tribus to purchase the 450,000 square foot 211 building. That was their deal. And no real surprise here, the latest research from Newmark showed that demand for bulk warehouse space in Detroit remained strong in the third quarter of the year, despite the economic slowdown caused by the COVID-19 pandemic and state shutdown orders. Newmark's third quarter industrial trends data did show one negative for the Detroit industrial market, though. The industrial vacancy rate in the Detroit area edged up 10 basis points to 4.5%. Despite that, Newmark's report highlighted an industrial market that continues to thrive in Detroit. During the past 10 quarters, users have absorbed 6.3 million square feet of bulk warehouse space, so it logically follows that nearly 80% of the 5 million square feet of industrial product under construction in Detroit is speculative bulk warehouse. Demand is particularly strong for modern, efficient facilities, Newmark says. And if you're wondering how strong, the 26 million square foot inventory of Class A bulk warehouse space has a vacancy rate of just 1.6%. Todd, over to you.
It's no secret now that the multifamily sector has held up well through COVID. It may be counterintuitive that even with high jobless rates and eviction moratoriums, but that's COVID. It's counterintuitive. Our Journals held a multifamily event last week with numerous lenders, agency representatives. I was there asking questions as usual. Unsurprisingly, low rates are causing a refinance boom. Laura Simpson, director with HUD, what is the lowest rate you have seen this year?
We've seen as low as 2.05. That's as low as we have seen. I think that's on a refinance. We're holding steady at 2.45. Is I've seen 2.35. I mean, I don't know what Freddie is. I don't know kind of where other places are sitting, but that's what we're seeing.
We've also got Samantha Miller with Freddie Mac. Samantha, where are Freddie rates?
On the fixed rate side, I'd say low to mid threes all in. That's pretty consistent depending on leverage. On the floating rate side, we did transition from LIBOR to SOFR recently. August 1st, we started offering SOFR-based loans, and we'll have fully transitioned now We're not quoting any more LIBOR loans, and December 31st is our last date to purchase LIBOR. So in terms of our ARM spreads, we're at, I'd say, 260 to 290 gross on the floating rate product. That has been really strong, a strong business for us, and we've done a good amount of our floating rate business this year.
Brett Olson, super broker with Grandbridge. Can you fill us in on Fannie rates as well?
Todd, I can jump in here a little bit from what we're seeing on the Fannie Mae side in terms of pricing. And a lot of what we do is tier 2 business, or kind of their full leverage. Right now, seeing a lot of 75% loan to value, 125, 130 debt service coverage minimums. But that type of loan pricing today is probably around 315 all in rate.
Developers and owners have been the beneficiaries, but so are low-income renters. Lower interest rates have allowed affordable housing developers like Sherman Associates, one of the largest affordable housing developers in the nation, to make sense of new projects.
On our end, the biggest driver for moving some of these projects forward over the last 7 months has been the drop in interest rates, both immediate but also long-term projection on where interest rates will be 2 to 3 years down the road as we bring in long-term financing. The drop in interest rate on our construction financing has a nominal impact on moving a project forward, but that long-term interest rate certainly has a more substantial, as we're looking at agency takeouts with HUD or Fannie, to be able to underwrite a rate that's 75 to 100 points lower for the long term certainly is having a meaningful impact on the viability of these projects.
Chris, are you also taking advantage of these rates and refinancing?
So for the last 8 months of the roller coaster we've been on, one of our big focuses has been refinancing existing debt. And during that 8-month period, we've refinanced about half of our portfolio debt using a variety of tools. And as you noted, one of those tools has been HUD insured financing, where we may have a 8 or 9 or 10% prepayment penalty. And then what we're electing to do is roll a portion or all of that into the new rate. And we do cover some of it. And those refis are making sense right now. HUD, and these are deals that in certain cases we refinanced 5, 6, 7 years ago. So rates have come down that much. Again, we're back to where we were probably late 2012, if not a bit lower today. So HUD is low 2s plus MIP. And we're looking to refinance a few deals here over the next 6 months and roll prepays into the new rate to get them down into the 2s. And we're also working on a variety of other, we've also closed a variety of other refi transactions from Fannie Mae. We did a lower leverage Fannie Mae execution on an asset about 2 weeks ago, 60% LTV, and had that rate down well below 3 with 8 years of IO. And we've done a lot of deals with our banking relationships, and that's been a big thing for us, is just working with our existing relationships to refinance assets here and take out, in certain cases, construction financing and kind of mini perms that were higher cost, higher leverage. We've closed on several fixed rate deals and several swaps over the last 7 months, and a lot of those have been low to mid 3s on 7 to 10 year executions. But a lot of this is long term. We're with HUD, that's 35 to 40 years. With Fannie, it's 10-year deals, and with these fixed rate and swaps, it's 7 to 10. So we're locking in these low rates between really low 2s to low 3s for the next 7 to 10 years. And
there you have it. Multifamily finance is booming, in case you haven't figured that out. What a great event. Hey, you can log in to you don't even have to log in. You can go to our YouTube page where you found this show. You can see the full clips of this event, the whole thing. It's on there, as well as a whole bunch of other events, 100 plus, that we've been doing since April to keep you in the loop on things like multifamily interest rates. I sat down with Conrad Madsen, Paladin Partners. Conrad, an industrial broker from Dallas, created a really cool brokerage firm. We talk brokerage, Dallas, and nearshoring. What's going on, my friend?
How are you, my man?
I'm fantastic.
Awesome.
I like your background. Is that a virtual background, or is that your?
No.
Oh boy.
It's legit.
All right, so let's start with Paladin. because
Yeah.
I admire your presence on LinkedIn a lot. I'm trying to help us build ours. And I
Yeah,
look at you and you're a LinkedIn rock star, social media rock star.
Yeah.
But you've posted some stuff about Paladin that if I was a broker, I'd be really curious. So tell me what the story is there.
Paladin's an interesting story. It was founded because we were on a mission to just really do things better in the industry. And we all came from either local or regional or national firms. And, I think when you come from those places, you take little pieces of what all those different places do right and what they do wrong, And so what we tried to do was really take all those and put all the best practices together, but mainly focused around really the culture, to me, the culture and the organization is the most important thing for a successful company, regardless of industry, and so in the last about year and a half, we really kind of reinvented Paladin on a few fronts. One being we started paying brokers better, right? Because that's always a conversation starter for guys. Two, we're also opening up the equity kitty because to me, the best firm I was ever associated with was my first firm, which was an NAI affiliate that was eventually acquired by Transwestern. And you had 20 partners in that firm, 10 in Dallas, 10 in Fort Worth. And when you have that environment of people with actually equity in something, you have everybody rowing the boat the same direction. And you're inspired to recruit, grow young talent, root for your neighbor, collaborate, all those things, because at the end of the day, your name's on the line, and you have interest in something. And so, that's what we kind of started doing on the front end. But what I'm most passionate about is really our give back platform. And next week, we're going to be sending out our invitations. Here in Texas, we're open for business and restaurants are open again. And, we're going to have a Christmas gala, and it's going to be basically a Christmas give back gala where we're taking, two of our biggest charities are going to be there and speak about them. And then we're going to be, donating the percentage of our fees back to them that we've earned through 2020, and ultimately this world is all about how you impact other people's lives, and especially in a positive manner. I tell people all the time, it's not about how much money you make, it's how many people show up to your funeral someday. One of the charities I'm actively involved in is called Team Luke Hope for the Minds. And that was a lot of the inspiration behind the Give Back platform, but also I've spent a lot of time at Hillwood's offices, and Hillwood is Ross Perot's company. And I was fortunate enough to be at their broker trip last summer up in Colorado Springs. And at the dinner on Saturday night, Ross Perot Jr. got up and talked about his dad. His dad had just passed away about 3 weeks earlier. And he told a lot of stories about his dad and how his dad had impacted a lot of other people's lives, and just went on and on and on about that. And I've always seen that in the culture of the people that work at Hillwood. They knew they had a greater cause, because of the leader in Ross. And I just looked up after that night just going, boy, I haven't done really anything on this planet other than I've made a great life for my family, but I haven't impacted enough other people.
Well, I love the Paladin story, but let's talk Dallas Fort Worth. Well, let's talk industrial then, right? So
Yeah, sure.
It's going bananas. Am I wrong?
Yeah. No, it's crazy.
For people outside of Dallas, because this is a national show,
Sure.
Dallas is it a logistics hub?
100%.
That's what I thought. So it's San Antonio, Austin, stuff's passing them up and coming up to Dallas, and that's your hub kind of for that Central Texas, Northern Texas.
So here's how it mainly works is you got the port in LA, gets put on a rail line, and it goes all the way to the intermodals, so everything from from the Far East comes into the ports of LA, Long Beach, and then into the intermodal yards here in Dallas-Fort Worth. And we're central to really this whole southwestern region. And because of that, we are the distribution hub. And so then the product goes up to Oklahoma City, Little Rock, Arkansas, over to Louisiana, down to Houston, Austin, San Antonio, Laredo, El Paso, West Texas, all that. Then you also have the Mexican contingent. So you come up through Laredo or basically McAllen, where I grew up, and all the maquiladora business that's along the border or goods that are from interior Mexico are coming up those two major interstates, and they're coming up to Dallas-Fort Worth, where typically their distribution center is located. And again, then it's going on from there. You know, what's interesting is Houston almost is the same size as Dallas population wise, but Dallas is approaching 1 billion square feet of inventory on the ground right now. And Houston, here they are, a port city, only has 600 million. So we're almost twice as large as Houston with the same employment base. So when you factor all those, the airport, the central location, I-20, I-35, we are the hub of the Southwest, just like LA's on the West Coast, Chicago in the Midwest, and New York, New Jersey on the East Coast, and then Atlanta for the Southeast. That's just how kind of the distribution network works. Dallas-Fort Worth, 6% plus or minus, okay? Normal times used to be, good times used to be 8 to 9%, so we've come down from there. Bad times, it got, 2009, we got up to around 11%. Dallas has available land, unlike a lot of places that are landlocked. So what's happening now is we're honestly almost running out of land in what we call infill now. And so now guys are even going out farther. But the good news is we're not restricted by mountains, lakes, rivers. We can continue building and going as far out. And when you look at, why I'm so bullish on Dallas-Fort Worth is one, every week you guys read about some new corporate relocation from California.
Right.
Okay? And
a lot of Teslas coming your way.
Yeah, and so all those guys that are going to support Tesla, they're going to put their distribution center most likely here in the DFW area because it's only 2 hours down there,
Oh, I just mean the executives come into town with their Tesla with California plates, and all of a sudden they're going to go buy a six-shooter for the sidearm, and they're going to be
That's right.
Texans. That'll be fun to watch.
So we have all this corporate relocation. I think the cost of doing business is so much more attractive in Texas. Low income, no state income tax, cost of living's low, all those when you look at what kind of home you can get here for the equivalent over in California, it makes people's minds blow up, it's unbelievable. And so when you factor, lower regulations on companies and just ease of doing business and all those things, the relocation is going to continue to come. And everybody likes to talk about the big ones like Toyota, Mass Mutual, all the big one, Liberty Mutual, I should say, all these big ones, but really it's all the tertiary and secondary companies that support those companies. And so then those people come, and take up industrial space and office space and all those things. And so, then you factor on just what we've talked about before, the onshoring / nearshoring. Well, if you're nearshoring, you're going to go down to Mexico because now when you factor in the cost of labor that's risen in China over the last 10 years and you add the logistics cost, it's almost even with Mexico now. And so I truly believe American manufacturers, especially due to the pandemic, then got a wake-up call about supply chain interruption and are like, we can't really depend on China to be making all of our technology stuff and prescription drugs and all these things. So I truly believe the higher end stuff, some of it will come back to the United States. The lower end stuff, think toys and all those other things, cheaper goods, I really think they're going to go down to Mexico because the benefit of that is within a day's truck drive, that product can be in your distribution center here in Dallas-Fort Worth and then on to your final customer versus it sitting on a boat for 3 weeks.
If you were to talk to developers, and I'm sure you do,
yeah.
What are they building just 5% office,
Yeah.
as many dock doors as possible. That's what's going on right now. No manufacturing. Let's just put up the boxes and
Yeah, well, I mean, the manufacturers, even if you don't need the dock doors, they need big blocks of space, and they're building the buildings pretty flexible where a manufacturer could have raw goods come in one side and then you could cross dock it and have finished goods come out the other side, right? And a lot of these buildings are built where you can cut them down to, 250,000 square feet, in a scenario like that, and it works. And so, but most of them are the big 500,000 to 1 million square footers, but then they're also building a lot of shallow bay stuff, a 250,000 square foot building that's maybe a front park rear load where you're cutting down the spaces to, 30,000 square feet, because it's what I just told you earlier about the secondary and tertiary companies that come in to support those big ones. They need the smaller spaces. So you got to have a combination.
It's not just the mega REITs coming in.
No, it's just not the mega. It's not just it is a lot of the mega REITs, but there are some local players, but they're targeting every aspect, from the smaller users to the big box. Now, different submarkets are a little bit different. Like DFW Airport, you can build that rear load product all day long, and you're going to lease it overnight. There's some other areas of the city you wouldn't build that.
Interesting. Well, that makes sense, right? It's going to go where it's supposed to go.
Sure.
So I'm going to compare and contrast that to the Midwest, Ohio, Indiana, Chicago, where one of the questions they're asking there is, we've got new distribution centers coming in. We don't have enough workers. We don't have enough employees to do that work.
Yeah.
Is that an issue in your area?
Oh, labor's tied everywhere, Todd. I mean, I think labor is the most crucial part of most companies' searches, and it definitely drives manufacturing, particularly because of the headcount that you have in manufacturing, to certain areas of the city that have a more concentrated blue collar workforce in those areas. That take those manufacturing type jobs. And so I think, these companies are learning that they've got to pay well, they've got to offer benefits, they've got to do things to retain folks. Now, here's one interesting thing that I think's happened though. 2 or 3 years ago, every tenant would tell me that I represented, I don't want to be next door or close to Amazon. Okay? Because Amazon pays more. Okay.
Oh.
All right.
Okay.
And so they were worried about Amazon stealing all their employees. But what I've found out in talking to folks and in my research is people aren't as scared of Amazon as they used to, because here's what happens. People go into work for Amazon, they get that extra $1 an hour that they are not getting at their old firm. But when you talk to the people at Amazon, the culture's not great and they work them really, really hard. And so they stay there 6 or 12 months and they go, this extra $1 isn't worth my lifestyle.
I want to talk about Mexico a little bit, because if I'm Blackstone and I have all the money in the world and I start to think, okay, nearshoring has legs.
Right.
How does Mexico, you lived on the border, how does it compare to China? Is the workforce the type of workforce that's ready to take on this work? Because I can tell you, living in the northern United States, we get mixed reviews about Mexico and what's going on.
Yeah, the big mixed review on Mexico is the safety issue, right? I mean, the cartel problem that they have along the border. Here's what I do know, is almost every one of those business parks is about a half a mile from the international bridge, right? So you're not having to go, even as American, you're crossing over, you're going almost immediately into that business park. You're not having to get into the deal with the riffraff. Plus, also, the cartel really doesn't want attention. So the last thing they want to do is mess around with all these Fortune 500 companies or what have you that have operations over there. Is the workforce there? Absolutely. I mean, I have been in the plants. I mean, they run 24/6, 24/7, 3 shifts. the labor's there and it's pretty skilled. What's along the border right now is actually a lot of automotive parts. You'd be shocked, but it's a very heavy automotive part area to service. We got GM's plant right here in Arlington, which builds every Tahoe and Escalade and Denali in the country, and the other factories. You got Toyota down in San Antonio building trucks and all these other things, and so a lot of it's those OEM and aftermarket auto parts that are built along the border.
So, and then as that's going to expand if nearshoring is what we think it's going to be.
All right,
Awesome.
buddy.
Hey,
Have a great
fantastic.
weekend, man.
Yeah, you too.
All
Okay,
right,
thank
buddy.
you for your time.
Take care, Todd.
You can catch that full interview on Spotify by the end of the week. We get a little into politics, but who can help it? It's everywhere. Hey, thanks everyone for another fun show. See you next week. I'm out of here.